Imagine waking tomorrow to discover that every billionaire has been taxed heavily overnight. Governments suddenly collect hundreds of billions of dollars, promising better schools, healthcare, infrastructure, and reduced inequality nationwide. At first, the idea sounds remarkably simple. Tax the richest people more, raise enormous public revenue, reduce inequality, and solve many of society's most persistent economic and social problems simultaneously. For decades, the phrase, "tax the rich," has become one of the world's most debated economic proposals. Supporters view it as fairness, while critics fear unintended consequences for investment and growth. The debate extends far beyond politics. It raises fundamental questions about wealth, incentives, entrepreneurship, government spending, economic efficiency, and how societies should distribute both opportunities and financial responsibilities fairly. Nearly every developed nation already taxes wealthy individuals at higher rates than lower-income households. Progressive taxation remains a central feature of modern fiscal policy across most advanced economies worldwide today. Yet, inequality continues growing in many countries despite progressive tax systems. This reality raises an important question. Why doesn't simply raising taxes permanently solve the problem of concentrated wealth? The answer lies in understanding how modern wealth differs from ordinary income. Many extremely wealthy individuals earn relatively little traditional salary compared with the enormous value of their investment holdings. A billionaire's fortune often consists primarily of company shares, private businesses, real estate, intellectual property, or investment portfolios, rather than cash sitting inside personal bank accounts awaiting taxation immediately. When stock prices rise dramatically, billionaires become wealthier on paper, without actually selling assets. This increase creates unrealized gains that many tax systems generally do not immediately tax directly. Taxing unrealized wealth presents significant challenges. Asset values fluctuate constantly, making annual valuations difficult while potentially forcing owners to sell businesses or investments merely to pay tax obligations. Imagine owning a rapidly growing company worth billions of dollars, but generating little available cash. A substantial annual wealth tax might require selling ownership simply to satisfy government requirements. Supporters argue billionaires should contribute more because they benefit enormously from stable legal systems, educated workers, public infrastructure, and financial markets funded partly through taxpayer-supported government institutions and services. Critics respond that excessive taxation may discourage entrepreneurship, innovation, investment, and business expansion by reducing incentives, rewarding individuals willing to accept extraordinary financial risks and uncertainty over many years. Economic incentives matter because starting successful companies involves significant risk. Most businesses fail, and entrepreneurs frequently invest years of effort before earning substantial financial rewards or achieving lasting commercial success. If governments capture too much potential reward, fewer individuals may pursue ambitious ventures. Reduced entrepreneurship could eventually slow innovation, productivity growth, employment creation, and overall economic development throughout society broadly. History provides examples supporting both perspectives. During certain periods, high tax rates coexisted with strong economic growth, while other eras experienced slower investment despite lower taxation and business-friendly policies instead. Context matters enormously. Tax policy rarely determines economic performance alone. Education, technological innovation, political stability, regulatory quality, demographics, global competition, and consumer confidence all influence national prosperity significantly over time. Another limitation involves international mobility. Wealthy individuals and multinational businesses increasingly operate across borders, allowing assets, investments, profits, and even personal residency to relocate between different tax jurisdictions relatively easily. If one country imposes substantially higher taxes than competitors, some investors may move capital elsewhere. Governments risk collecting less revenue than expected, despite significantly increasing official tax rates domestically overall. This phenomenon, sometimes called capital flight, complicates national tax policy within today's interconnected global economy. Financial assets often move internationally much faster than workers, factories, or traditional physical businesses can relocate. Governments therefore face balancing competing objectives. They seek raising sufficient revenue for essential public services while maintaining attractive conditions, encouraging investment, innovation, entrepreneurship, and long-term economic growth simultaneously across competitive global markets. Corporate taxation introduces additional complexity. Companies ultimately consist of shareholders, employees, suppliers, and customers. Higher business taxes may influence wages, prices, dividends, hiring decisions, or future investment strategies differently. Economists continue debating who truly bears corporate tax burdens. Depending upon market conditions, costs may fall partly upon investors, workers, consumers, or combinations of all three groups over time. Another challenge concerns tax avoidance rather than outright tax evasion. Wealthy individuals frequently employ accountants, lawyers, trusts, foundations, and sophisticated financial planning techniques, reducing legally owed taxes through existing regulations. Closing legal loopholes often proves as important as increasing tax rates themselves. Broad tax bases with fewer exemptions sometimes generate greater revenue than extremely high rates containing numerous deductions and exceptions. Some economists argue focusing exclusively upon taxing billionaires distracts from broader fiscal realities. Even confiscating enormous fortunes once cannot permanently finance decades of government spending commitments or expanding social programs. Government expenditures occur continuously every year. Sustainable public finances therefore require reliable recurring revenue from broad economic activity rather than depending exclusively upon exceptionally wealthy taxpayers with highly variable asset values. Middle-income households collectively generate substantial tax revenue because they greatly outnumber billionaires. Modern governments typically depend upon broad tax systems supporting consistent funding for education, healthcare, pensions, and national defense together. This reality does not necessarily imply wealthy individuals should avoid higher contributions. Instead, it illustrates why fiscal sustainability usually requires balanced taxation across multiple income groups and economic activities consistently. Many countries combine progressive income taxes, consumption taxes, payroll taxes, property taxes, corporate taxes, capital gains taxes, and inheritance taxes, rather than relying upon any single revenue source exclusively. Inheritance taxation generates another contentious debate. Supporters argue inherited fortunes reinforce inequality across generations, while opponents claim taxing accumulated family wealth represents unfair double taxation after lifetime earnings were already taxed. Capital gains taxes similarly balance competing objectives. Lower rates encourage investment and entrepreneurship, whereas higher rates potentially increase fairness by taxing wealth growth more consistently alongside ordinary employment income equally. Public opinion often supports higher taxation when citizens trust governments spend revenue efficiently. Confidence declines, however, if taxpayers perceive waste, corruption, bureaucracy, or ineffective public programs, reducing measurable social and economic benefits. Consequently, debates about taxation inevitably become debates about government performance. Citizens willingly contribute more when convinced public spending genuinely improves infrastructure, education, healthcare, security, and long-term national prosperity effectively together. Nordic countries frequently demonstrate this relationship. Relatively high taxation coexists with broad public support, partly because citizens generally perceive strong public services and comparatively transparent government institutions, delivering tangible societal benefits. Meanwhile, other nations struggle collecting taxes despite lower rates because widespread distrust encourages avoidance, informal economic activity, or political resistance against expanding government revenue through additional fiscal measures consistently. Technology introduces entirely new challenges. Digital companies generate profits across numerous countries simultaneously, making traditional taxation based upon physical presence increasingly difficult for governments attempting fair international revenue allocation today. International cooperation has therefore expanded through efforts establishing minimum corporate tax standards, reducing profit shifting, and limiting opportunities for multinational corporations, exploiting differences between national tax systems strategically. Ultimately, taxation involves trade-offs rather than perfect solutions. Every additional dollar collected, potentially funds valuable public services while also influencing incentives affecting investment, entrepreneurship, consumption, savings, and broader economic decision-making across society. The phrase "tax the rich" captures genuine concerns regarding inequality and fairness. However, transforming that slogan into effective policy requires navigating complex economic realities, extending well beyond political rhetoric or campaign promises. Successful tax systems generally pursue multiple objectives simultaneously. They raise sustainable revenue, encourage productive investment, promote fairness, minimize avoidance opportunities, maintain economic competitiveness, and preserve incentives supporting long-term prosperity for everyone. Perhaps the greatest limitation of taxing the rich is expecting one policy alone to solve inequality. Education, housing, healthcare, competition, innovation, and opportunity also shape wealth distribution across generations profoundly. History repeatedly demonstrates that prosperous societies require more than effective taxation. They also require productive economies generating wealth before governments can successfully redistribute portions through public investment and essential social services. The real challenge, therefore, extends beyond collecting more taxes. It involves designing economic systems where prosperity grows broadly enough that governments, businesses, workers, entrepreneurs, and investors all contribute toward shared long-term national success. Taxing the rich can reduce inequality, finance valuable public programs, and strengthen social stability. Yet lasting prosperity ultimately depends upon balancing fairness with incentives, ensuring economies remain dynamic while opportunities become more widely shared.